Hey everyone, and welcome back to Everything About Accounting. After covering accounting itself and then assets, today we're tackling another crucial concept: liabilities. Simply put, liabilities are what a company owes to others. These are obligations that will require the company to give up assets or provide services in the future. Think of them as the debts or responsibilities of the business. Remember our lemonade stand? If you borrowed money from your parents to buy lemons and sugar, that loan is a liability. You have an obligation to pay them back in the future. In accounting, liabilities can be categorized based on how soon they need to be paid. Current liabilities are obligations that are due within 1 year, such as accounts payable, money owed to suppliers, short-term loans, and salaries payable. Non-current liabilities, on the other hand, are obligations that are due beyond 1 year. These can include long-term loans, bonds payable, and deferred tax liabilities. Understanding a company's liabilities is just as important as understanding its assets. Liabilities represent claims against the company's assets. The difference between what a company owns, assets, and what it owes, liabilities, is a key indicator of its financial health. Just like assets are recorded on the balance sheet, so are liabilities. They provide a clear picture of the company's obligations to external parties. So, to summarize, liabilities are future obligations or debts that a company owes to others. They can be current, due within a year, or non-current, due beyond a year, and are a critical part of a company's financial picture. There you have it, liabilities explained in under 90 seconds. Feeling more confident with accounting terms? Let me know in the comments. And make sure to subscribe for more quick and easy explanations. What accounting concept should we break down next? Thanks for watching, and I'll see you in the next video.